The strange reason your best tax year is also your worst mortgage year. Here's a strange truth about being self-employed. The better you are at taxes, the worse you look to a mortgage lender. Think about that for a second. The same person who is winning April is losing in June when they try to buy a house. Same income, same person, same business, different game. And almost nobody is telling them this is happening. I am Ron Siegel, certified liability advisor, helping families build wealth through strategic debt management. And today I want to talk to the people who built something. The shop owners, the contractors, the consultants, the realtors, the 1120 filers who write off everything they're legally allowed to write off. And if that's you, this story is for you. Here's something I say on our show quite frequently. There is one U.S. tax code, but there are two systems running inside it. One for the informed and one for the uninformed. Same code, same rules, same forms, two completely different outcomes depending on which side of that line you stand on. It's two games played with the same number. Game one is called Pay Less to the IRS. You play it once a year with your CPA. The goal is to make your net income look as small as possible. Mileage, equipment, home office, meals, payroll, retirement contributions. Every line item is a tool. The lower the bottom number, the better you played. Game two is called Qualify for a Mortgage. You play that game when you want to buy a house. The lender asks for the same tax return. They look at the same bottom number, and they decide based on that one tiny number how much house you can afford. You can see the problem, right? The informed know how to play both. The uninformed only know game one. They win in April, lose in June. And nobody tells them why. That's the whole point of this story, this episode, to move you from one side of that line to the other. Let me make this concrete. A business owner walks into my office. Top line on the 1120, gross receipts, $500,000, real money, real business. After the CPA does their job, the bottom line, the taxable income looks closer to 50 grand. The owner saved a fortune in taxes. Smart. That is exactly what a good CPA is supposed to do. Now they want to buy a house. Conventional lender pulls the return, looks at 50 grand, says, we can get you approved for about $300,000. And the borrower has $500,000 in revenue, and they're being told they can buy a starter condo. That is the trap. The quiet solution. Here's what most lenders won't tell you. There is a different program for this exact person. It's called a CPA gross receipts loan. And it does not look at the bottom of your tax return. It looks at the top. The math is straightforward. Your CPA writes one letter on their letterhead. The letter states your gross receipts from line 1A. They state your ownership percentage. They sign their PTIN. That's the document. We take the gross receipts. We apply a standard expense factor of 50%. We divide by 12. That's your monthly qualifying income. $500,000 in gross receipts becomes about $20,000 a month in qualifying income. Suddenly, the same business owner who couldn't get a starter condo is buying the house they actually wanted. No tax returns submitted, no transcripts, no 4506C, one letter, a couple of months bank statements, done. Who is this for? This loan exists for a specific tribe of people. If you're listening and any of these sound like you, pay attention. You own a business and your CPA is good at their job. You're a realtor with a great commission year that looks thin on a Schedule C. You're a 1099 contractor who pays quarterly taxes and writes off everything legitimate. You're an 1120C corporation owner with a healthy company and a tax return that on paper makes you look broke. You're not broke. You're strategically minimized. There is a difference. The bigger idea, here's what I want you to take from this episode. Whether you're self-employed or not, eligibility is not suitability. Most lenders are eligibility shops. They check the boxes. If your file fits in the box, they say yes. If it doesn't, they say no. They are not asking whether the loan is right for you. They are asking only whether you fit the box. A certified liability advisor asks a different question. Not can this person get a loan? We ask, what is the right tool for this person, given everything we know about how they make money, how they manage debt, and where they want to be in 5 years. That's why strategy beats rate, always. Rate is a number. Strategy is a plan. If you are self-employed or you know somebody who is and they have been told no by a conventional lender, do this one thing. Go to rsrlinks.com/certified buyer. That's rsrlinks.com/certified buyer. We look at the gross receipts loan, bank statement loan, and every other tool we have, and we'll tell you the truth about what actually qualify for. No pressure, no sales pitch, just a real answer. Or call us directly at 800-306-1990. That's 800-306-1990. Here's the last thought I want to leave you with. Your CPA is not your enemy. Your tax strategy is not your enemy. The system is just two games played with the same number, and most people only know how to play them one way. I help people play both. I am Ron Siegel, your certified liability advisor, helping families build wealth through strategic debt management. Thanks for listening to the Borrow Smart segment, brought to you by rsrlinks.com/keysteps. That's rsrlinks.com/keysteps.